Hey guys, Rudy MLO here, NMLS 2491738. So for the last 5 years, mortgage interest rates has been the hot topic. Now mortgage rates aren't set by any single bank or lender, they're influenced by the broader economy. The biggest driver is inflation and the Federal Reserve. When inflation is high, the Fed raises its benchmark rate to slow down the economy, and that tends to push mortgage rates higher. When inflation is low, the Fed lowers rates, which usually helps bring mortgage rates down. Important factor is the bond market, especially mortgage-backed securities, where lenders bundle mortgages and sell them as bonds. When investors buy a lot of those bonds, mortgage rates go down. When demand is weak, lenders have to raise rates to attract investors. Rates are also influenced by overall economic conditions like job growth, unemployment, and consumer confidence. So while lenders deliver the loans, the actual rate you get is shaped by the bigger picture of inflation, the Federal Reserve, and the bond market. The Federal Reserve doesn't directly set mortgage rates, so don't be surprised if Fed lower rates and mortgage rates increase. What it does control is the federal funds rate, which is the interest rate banks charge each other for overnight loans. That's a very short-term rate, but it influences the whole financial system. Oh, mortgage rates usually follow the 10-year Treasury. When the Fed raises its rate, it becomes more expensive for banks to borrow money. Banks usually pass that cost along to consumers through financing things like credit cards, auto loans, and sometimes mortgages. On the flip side, when the Fed lowers the rate, borrowing gets cheaper, and that can help push interest rates down. Please subscribe and follow. Thank you.